Somewhere in the United States right now, a small business owner is sitting across from a loan officer, completely confused. Her business cleared $160,000 last year. She has money in the bank. Her credit score is 762. She's been in business for 4 years, has consistent clients, and has never missed a payment on anything in her life. And the underwriter is telling her she doesn't qualify. Not because she's irresponsible, not because her finances are unstable, but because the mortgage underwriting system, the actual mechanical process that determines approval, is reading her financial life through a lens that was never designed for someone like her. And here's what makes this worth understanding. The underwriter isn't wrong. They're following the rules exactly as written. The system is functioning correctly. That's the part that most people miss, and it's the part that explains everything. Mortgage underwriting in the United States operates on a deceptively simple premise. Prove that your income is real, stable, and sufficient to service the debt. For a salaried employee, that proof is almost effortless. Pay stubs, a W-2, maybe an employment verification letter. The documentation is clean, standardized, and designed to plug directly into the underwriting model. For a self-employed borrower, that same proof becomes a months-long documentation exercise, and even after assembling everything correctly, the income figure that emerges from the process may bear little resemblance to what that borrower actually earned. The reason comes down to one document, the federal tax return, and more specifically, one section of it. Schedule C is the IRS form where self-employed individuals report business income and expenses. It's where gross revenue comes in at the top, business deductions get subtracted line by line, and net income, the number that represents what the IRS considers taxable profit, appears at the bottom. Mortgage underwriters use that bottom line number, not the gross revenue at the top, the net income after every deduction has been applied. This is where the structural collision begins. The U.S. tax code is explicitly designed to encourage business owners to document and deduct their expenses. Doing so reduces taxable income, which reduces federal and state tax liability. Every CPA working with self-employed clients understands this. Maximizing deductions is standard, sound tax practice. But maximizing deductions also minimizes the income figure that appears at the bottom of Schedule C. And that minimized figure is the one the mortgage underwriting system uses to determine how large a monthly payment you can carry. So here's the dynamic in plain terms. The better you are at managing your taxes as a self-employed person in America, the worse your mortgage application looks on paper. Those two things are true at the same time. The system created them simultaneously. Let's put a real number structure around this so the mechanism is completely clear. A freelance marketing strategist generates $145,000 in gross revenue in a given tax year. Over the course of that year, she incurs $58,000 in legitimate, documented business expenses, contractor payments, software, advertising for her own services, travel to client meetings, and a home office deduction based on square footage. Her Schedule C shows net income of $87,000. Her mortgage underwriter evaluates her at $87,000 annually or $7,250 per month in gross qualifying income. Using a standard 43% debt-to-income ceiling, her maximum allowable monthly debt obligation, including the proposed mortgage payment, property taxes, insurance, and any existing debts, cannot exceed approximately $3,117. Now consider a salaried marketing director earning $87,000 per year at a company. Same qualifying income number, same DTI ceiling, same monthly debt limit. But the salaried employee arrived at $87,000 without deducting anything. That's the full number. The self-employed borrower arrived at $87,000 after absorbing $58,000 in business expenses that were real costs required to generate $145,000 in revenue. The underwriting system treats both borrowers identically at the income evaluation stage. It doesn't have a mechanism to weigh what was required to produce that income. It reads the Schedule C net figure and applies the formula. If this breakdown is giving you a clearer picture of how the mortgage system actually operates, not just the surface rules, but the structural logic, that's what this channel is built to deliver. Subscribe if you want to keep going deeper into how these financial systems actually work. Now, there's a second mechanism layered on top of this, and it creates problems specifically for business owners whose income is growing. Conventional mortgage underwriting, the guidelines that govern loans backed by Fannie Mae and Freddie Mac, which represent the majority of U.S. Home loans requires 2 years of self-employment tax returns. The underwriter averages the net income from both years to produce a qualifying income figure. The intent is to smooth out volatility. A single strong year might not repeat. Averaging 2 years gives lenders a more conservative, stable picture. But here's what that does to a growing business. A contractor who went independent 3 years ago had a net income of $52,000 in his first full year of self-employment. Startup costs were high, deductions were significant, and the client base was still building. In year 2, his business grew substantially. Net income reached $94,000. He applies for a mortgage in year 3. The underwriter averages year 1 and year 2, $73,000. That $73,000 is his qualifying income, not $94,000, not the trajectory, not the current monthly deposits hitting his bank account. The averaged figure pulled backward by a slower first year is what drives every qualification calculation on his application. Now run the deduction effect through that average number, and you have a borrower whose actual economic output is significantly higher than what the underwriting model is willing to work with. This is the architecture that produces the outcome we opened with. A business owner earning $160,000 in gross revenue with strong credit and cash reserves, failing mortgage underwriting, not because she isn't creditworthy, but because the documentation framework of conventional mortgage underwriting was built around a specific model of income, and her income doesn't fit that model without significant compression. The qualifying income that emerges from 2 years of average Schedule C net figures may represent 50, 60, or 70 cents on the dollar compared to her gross revenue. And the underwriting system has no adjustment mechanism for that gap. Some loan products have been developed to address this. Bank statement mortgages, which calculate qualifying income from 12 or 24 months of business or personal bank deposits, give underwriters a direct view of actual cash flow rather than tax return net income. These products exist at a meaningful number of lenders, but they come with structural trade-offs. Interest rates on bank statement loans are typically higher than conventional loan rates. Down payment requirements are often larger. Reserve requirements, the cash the borrower must demonstrate after closing, tend to be stricter. The alternative product exists, but the cost of accessing it is higher, which creates a situation where self-employed borrowers face a choice that salaried borrowers never encounter: accept a conventional loan's income compression or access an alternative product at a higher ongoing cost. Neither option is a mistake, but neither should be a surprise. What this system reflects, at its core, is an alignment problem between two major financial frameworks. The U.S. tax code rewards income reduction. Document your expenses, reduce your taxable income, retain more of your revenue. That's the design. The conventional mortgage system rewards income documentation. Show stable, verifiable, high net income on federal tax returns, and the qualification process works smoothly. That's also the design. Both systems are functioning as intended, but they were built to serve different purposes, and for self-employed borrowers, optimizing for one creates friction in the other. The American mortgage infrastructure was designed during an era when the salaried, long-term employee was the dominant income model. The underwriting guidelines that still govern most conventional lending reflect that era. The independent workforce has expanded enormously since those frameworks were established. But the documentation assumptions at the center of conventional mortgage underwriting haven't structurally changed to reflect that shift. Understanding this doesn't make the process easier overnight, but it changes what you're actually solving for. The self-employed borrower who understands how Schedule C net income feeds into DTI calculations, how 2-year averaging compresses qualifying income, and how deduction strategy affects loan eligibility, that borrower can plan around the system rather than be surprised by it. That kind of structural awareness is the difference between walking into an underwriting process blindly and walking in knowing exactly which numbers matter and why. Here's the question I'll leave you with, and I genuinely want your perspective in the comments. If the independent workforce now represents tens of millions of American earners, should conventional mortgage underwriting guidelines be restructured to reflect how self-employment income actually works? Or is the current system the right way to manage lending risk, even if it creates documented friction for a large and growing segment of borrowers? That's not a rhetorical question, it's a real policy tension, and your answer probably depends on which side of the W-2 line you're standing on.